Hello, I'm Nick Erner. I'm the Managing Director of Alkane Resources, an ASX-listed gold producer. We have mines in New South Wales and a large exploration deposit there as well, a large copper gold porphyry.
Nick, good to see you. What a time to be a gold producer, that's for sure. What's the gold price doing over there for you?
About $4,600 Australian,
Nice.
Which is incredible. So all time, I mean, off a tiny bit in the last 24 hours, but yeah, all-time record highs for Aussie gold price.
Right, and have you been able to take advantage of that? Obviously, you put your numbers out, out.
So not 100%. So we have about a third of our forward production through to June 27 is hedged at $2,850 Australian. So the hedge was set back in March 2023. And so we tend to get, on a $4,600 gold price, we would get, for all of our ounces, about $4,000 gold. So, yeah, we get about 90% of the benefit.
Wow. Okay. And so costs maintaining, we speak to some companies and they're sort of trying to sort of balance the, continuing cost of mining at the moment. What's it like in Oz?
Yeah. So in Oz, it's variable. So the cost increases we saw through COVID have absolutely stabilised, right? That's true for ourselves, true for everybody. In our particular case, our all-in sustaining cost this year should be between $2,400 and $2,600 an ounce. And that was our guidance for the full year. And the main reason that's higher is because the following financial year, so we're a July to June financial year. So the following financial year it should be around $2,000 an ounce. But the reason it's higher is because we're doing a whole heap of development in a new mining area. And so that goes through into that cost base. But yeah, it's quite remarkable margins for this period of time.
Right, and in terms of, obviously, I appreciate the kind of development work you're doing, but at the same time, that sometimes masks some inefficiencies with the regular business. Are you sort of still looking at those kind of cost reductions, efficiencies on the current production?
I don't think in any mining business you can ever, as you've alluded to, Matt, ever not look at those things. I think the big thing for us is, as we do like this new mining area, we sort of thought, what's the most efficient way we can be? We looked at the way we can do remoting, the way we can do ore passes, get more efficient trucking and things like that. We've put in a fine grind and flotation circuit for tens of millions of dollars to improve recovery by 7% in the process plant. We put paste in to improve ore recovery. So yeah, constantly we're looking at ways to make more money, be it that via increased ounces, increased ore recovery, or just lower unit costs. Absolutely, but that's not to say that things are definitely always plain sailing in the Australian cost base. We've had a reasonably high inflationary environment here for a little while, and so wages have continued to rise roughly in pace with inflation in mining, and some other things that we see in global pressures, like people might not realise, but the global pricing of explosives continues to rise.
Right.
Funnily enough.
Yeah. What about things like that's the cost side. What about the kind of optimizing the mining and the processing of the operations? I know that excluding the development work, excluding the hedging, etc. What
all
can
of that
you do?
Sort of stuff. Yeah, look, we're not the Lone Ranger in this perspective. In that, of course, people are reviewing their cut-off grades. Right, people are saying, what is the most efficient ore and the highest margin stuff I can put in? So our cut-off grades are flat or slightly falling. And so in our mining sequence, our cut-off grades are roughly 1.4 grams per tonne underground, which is quite low. And so we do include in our sequence things that in a different price environment we might have left behind. And so that does add to unit cost, but it absolutely makes more money.
Right. Okay. And in terms of like that kind of that development work, that kind of capital allocation that you've got earmarked over the next sort of 18 months or so, when all is told, what proportion is going to be spent on in terms of that capital? What's the question? A better way of asking this is, as you move through that process, that development phase, are you finding efficiencies, or do you continue to look the way that you've got it planned and make tweaks here and there? And if so, how much of that contingency will be used or unused at the end of that process?
Yeah, a little bit of both. So in our particular case, we've come to the end of a very large capital spend program. So we spent nearly 40 odd million Australian dollars installing the flotation and fine grind circuit. We spent 33 odd million dollars installing a paste plant. Both of those things are now commissioned and running. So we've really gone through a large part of our capital thing. So, both of those projects were higher than we originally budgeted when we first looked at them back in 2022. We had the COVID inflationary effect hit us with that. But from the budgets we then set out to, that we stuck to those. In terms of ongoing efficiencies, we constantly look for those things, right? In particular, always a little bit in mine design. We're constantly tweaking mine designs, but we also look for them in just particularly the way we go about, our cost management on site, spares management, maintenance, and things like that. But, broadly, you feel like you continue to improve to stand still, if that makes sense, in the inflationary environment.
Yeah. No, it's a kind of tough one. I know the feeling. Okay, we're just sticking with the kind of money side of things, because I think we want to kind of get into all the kind of the upside in a second here. In terms of like cash liquidity position, where are you today?
Yeah, so at the end of December, right, which is the last time that we had the balances, we had just under $40 million in cash and bullion, right? So bullion for us has to be in a safe to count it. So 35 for cash, 4.5 bullion. And we had a couple of $1 million of listed investments. So, that equaled $42 million. And so we expect that to rise in this current quarter.
Right. Okay, fine. And then with regards to the kind of debt side of things, in terms of that management,
the debt side of things, we had $45 million of debt to the bank that we took out the hedging on that I spoke to earlier. And we had, equipment finance about $18 million, and that's secured against equipment itself.
Right, and that's over kind of long-term payback, or do you look to clear the debt? 3 years.
So the $45 million is June 27, Matt, and then the other
right,
two and a half years. Yeah.
Right, and just be clear, because like I said, I want to kind of mop up this kind of the number side of things. In terms of the hedging, how much is hedged at how much, and when does that kind of clear the books?
Yeah, so hedging a bit over 70,000 ounces at $2,850 Australian per ounce.
Right. Okay.
And that's roughly a third of forward production through to June 27 is hedged.
Right, you've got the put options as well.
We do have the put options, but of course they'll only be triggered if there's some sort of collapse in the gold price. Yes.
Yeah. Okay. But
so we're much better off having those expire out of the money.
Absolutely. Okay. And that's the plan. You want to do that. Would you kind of, in this current environment, I think I know the answer, but in this current environment, would you look to do another hedge program going forward?
Yeah. So it's a very good question. Like the first thing is describe why we hedge, right? And broadly similar to most of the people. We hedge in order to make sure that we don't blow up through a debt repayment period, right? So traditionally, we might have hedged at $1,800, protecting a $1,400 per ounce cost position. But at the moment now, we're at $4,500, $4,600 an ounce, protecting a $2,000 cost position. So there can be a significant retreat before you would put anything under pressure. So in the current environment, unless there was a particular banking reason to do so, we can't see why we would add to the hedging profile.
Right. Okay. Makes sense. Look, you're in this kind of growth phase. You're looking to expand the ounces. Obviously, timing is wonderful, seemingly, as long as this gold price sustains or grows, indeed. So remind us of the guidance and sort of what you've hit and what you aim to hit in 2025.
Yeah. So this financial year, which finishes in another 5 months, we have given guidance of 70 to 80,000 ounces at $2,400 to $2,600 per ounce Australian. And as of December, we had roughly 33,500 ounces already poured. We had more gold in circuit and stuff like that, and we left our guidance where it is. So, I expect we'll be in the lower half of that production guidance. When you look forward at what's reasonable and within the cost guidance. So the following year we should see production increase from that position, right, up to be closer to the plus 80,000 ounce, and that's just purely a function of grade within the ore body. Nothing remarkably more or less that we're doing, but a function of.
And recovery as well?
Yeah, well, so the recoveries will have increased. Yeah, that's right. So in this financial year that passed, we had, for the first half and a little bit in this quarter, we had recoveries budgeted at 7% lower than what they're going to be because of the new circuit we installed. Yeah, that's right.
And explain that in terms of that kind of that process. Why 7%?
In our ore bodies, when we first mined the open cuts 10 years ago, we got recoveries of circa 90%, right? And this is grinding at, around 100 to 115 micron, grinding the ore down to that and going through a conventional CIL circuit. If we left that circuit exactly the same as what it is, in the new ore body we've opened up, we would have got recoveries around 84 odd %, right? Obviously, recoveries vary throughout the ore body. When we looked at that, we said, what still exists in that solid that's in tail? And what there was a portion of gold that would be liberated by grinding right down to 12 micron and then leached. And that equated to about 7%. And when we did the maths on that, because we've got, better part of, 650, 700,000 ounces in reserves going forward, right? We said, oh, well, hang on a minute. That's an absolutely worth chasing despite the $40 million capital cost. So that's why what it is. It's basically increased liberation of gold that is otherwise able to be leached in a conventional CIL circuit.
Right. Okay. And do you sort of continue to do sort of metallurgical testing as a result of that?
Yeah,
you do. Okay, that's an ongoing process.
Yeah. I mean, because particularly with new ore bodies. So we continue to feed ore into the plant. So of course you have a live in demonstration of what's occurring. So we have interesting different sections of the ore body. We have free gold. So we've had periods of time when nearly a third of the gold we're getting out has come out through a gravity concentrator like a Nelson and then gone through an intensive leach reactor. We have a very small portion of refractory gold, a couple of % that just is not coming out unless you install, something a lot more aggressive. We have this portion which has grown with time of fine gold that needs to be liberated. And then, of course, we have some sections of the ore body that have some deleterious elements, hardly any copper, but we do have some that have, some carbonaceous shales, and or shale-like, that they themselves are preg-romming. So for listeners, that's rather than the gold going to the carbon that you specifically put in the circuit yourself, it goes back onto carbon that's come in with the ore. That's so we do have some sections that have lower recovery. That's all in our budgets and everything going forward and included in all of our.
Right, and how have you gone about that in terms of that optimization of the ore blending to kind of maximize that kind of mill throughput and
to be honest,
recovery rates?
I'd love to say that our mine was so big that we could blend ore in that manner, but the reality is, when you're mining from ore bodies of ours, you're mining the 1.2 million tonnes per annum from underground. You have a stockpile and you're just moving mining fronts through particular areas, and you just have to know in advance metallurgically what's coming so you can adjust rather than blending to get a homogeneous feed.
Right, so that's an optimization of the engineering process.
Yeah.
In terms of those understood. And just can you sort of just explain? I'm sort of interested, sort of technically, the technical benefits of flotation and fine grind circuit compared to kind of conventional gold recovery for you. What can you just talk through that?
If we look at a conventional carbon-in-leach circuit, right? So ore is coming in, it's being milled in a mill, and it could be a semi-autologous, could be a ball mill, could be whatever it is. It goes up to the cyclones, it's separated. The large portions go back to the mill, the rest goes into the CIL, right? It's exposed to cyanide in solution, which pulls it into solution, free gold into solution, it binds on the carbon and it's then eluted off. If you have 110 micron particle, let's pretend that this is 110 micron, you might have a spot right in here, which is a piece of gold that's 25 micron across, but it's right there in the middle, right? if you grind this piece down to 12 micron, then that will be exposed, and then it will now leach. That's what we have. And the way that we do that is with we use an isomill, so it's a ceramic bead filled mill. So flotation, you're floating your sulfides that contain the gold very, very aggressively, and then you're putting that through into a mill, grinding out of it. It's then joining the stuff that didn't float and heading off through the leach circuit.
Right. Okay.
So you're basically increasing the exposed gold surfaces that can be attacked by the cyanide.
Interesting. Okay. And so obviously that feed coming from underground is in terms of I guess in terms of rock stability or structural challenges with underground mining at both Roswell and San Antonio. I mean, what are you experiencing? Is it
geotechnically very good. Underground. So it's not an area that underground mining personnel would describe as difficult or troublesome.
Right.
We have conventional ground support there. We're bolting and meshing. We use cable bolts in our truck turnout. We've got higher roofs. We're looking for extra support. We have a geotechnical engineer on site. We use bolt protection in the brow when we're blasting. So really, really standard stuff. Not complex or anything that's particularly demanding in the Australian context.
Okay, so given that, is there, coming back to this kind of engineering efficiency and so forth going forward, as you look to expand the production and the ounces coming out of the ground, is there any room for sort of automation of parts or all of this?
Well, we do. Our underground loaders, when they bog from the stope, right? So on remotes, they actually do run remotely. So our operators are either underground in the central area or on the surface. And the new loaders that we have bought have a control system that gives you the capacity for that one operator to run 2 or 3 loaders on the one level, interacting with each other and not running into each other using automation.
Right. Okay.
Whilst that's a lot more awesome in a really large porphyry or block cave, in ours, we get limited use from that because you have to have multiple stopes running on the same level, which in a mine of our size you don't always have. But yeah, we have that type of automation. That's the only stuff that really lends itself to automation that's not on the surface.
Right. Okay. So there's we kind of got into a little bit into the weeds there. Maybe kind of stepping back a bit. When you kind of looking at things like the operations and disruption, because you're saying, right, we're gonna move from the lower end of 70 to 80 guidance up to the maybe 80 plus next year, next financial year. What are the kind of production components that you look to say, look, we've got to be on this, guys, in terms of operational risk mitigation, etc. That we can't afford equipment failures or labor shortages or anything else. So what are they on?
I mean, one of the things that we're doing, of course, on top of all of this, is we're developing an open cut mine in parallel over the coming financial year. But so if you look at the key metrics which are typical in any underground, any operation like ours, number one is, I'm putting all safety metrics aside.
Yeah.
Number one is equipment availability. Right, so equipment has to be available, and so we've got we own and operate and maintain our own equipment. So we're a very motivated team there to keep stuff going. No sort of blame shifting between a contractor and stuff. So absolutely, equipment has to be available, and there's different availabilities we expect out of our underground boggers versus our trucks versus our production drills versus our development drills, right? So must be available. And then we look at when it's available, it has to be highly used, so the utilisation of available time. So we look for very high numbers with that. So we typically look for 85% equipment availability underground, and we look for plus 70% use of that available time, right? Because remembering that you have to move equipment around the place. On the plant, on the surface, we look for close to 100% availability. So we've got a reasonably softish ore. So when you take mill relines out of it, we get plus 97% availability there, and that just runs all the time. The paste plant, the new one we've installed, doesn't run, or at the moment we're trying to run it as much as possible, but because we're still bedding it in, but it will end up being sort of 50%, 60% utilised. People, we're a residential workforce, so we're not disrupted by flights. We have a lower cost because people have the benefit of seeing their families, but the cost of paying for their own accommodation. So unless some sort of flu goes through a community, you can imagine all your kids are going to the same primary schools and preschools and stuff, and so everybody ends up vomiting and knocks you around for a week. We have very low absenteeism of our workforce, and then of course we have a whole team that monitors contract supply pricing. But the big things are equipment availability, the different productivities per unit, drilled meters, et cetera, and then the plant and the plant recovery. So, but everybody you speak to, mate, of course, will give you the same list of KPIs.
Yeah, you say that, but issues still arise. So obviously, I think people, certainly us investors, kind of forget about that kind of the logistics side of things in terms of make sure key mining equipment and reagents and consumables are where they should be at the time they're meant to be there, and hopefully, I think you've described it. Maybe the pricing, inflationary pricing of COVID's gone away, right? So
we're in a great area, Dubbo, where the mine is, or just South Huffington, Dubbo and Parks. That's a 4.5 hour drive from Sydney, sort of 4 odd hour drive from Newcastle, both major ports. All weather trucking routes. It's not a cyclone area; it's not an earthquake area. So these sort of things mean that our supply chains are very, very robust. So our working capital is lower because of the inventories we hold. All this sort of stuff. So yeah, it's a very good place to operate.
Right. Okay. Let's get into the kind of projects themselves. Okay. If we go with Tomingley and San Antonio, and with regards to the underground potential, are you indicating that there's probably room for further underground potential there?
Absolutely.
Yeah. Okay.
So if you look at the ore bodies that we have the open cut mines that we ran were Wyoming 1, 3, Coloma and Coloma 2, right? So the underground, originally, the bulk of our tons come out of the Wyoming 1 underground. That was the largest open cut as well. We have taken that quite deep, hundreds of meters deep, and we have less, because of the depth of it and the way that ore body is, we have less ups. We still have discoveries we're making down at depth. We have less upside there than we do on the Coloma side. We're compiling some of those extensional results we're doing, but both Colomas are open at depth, and we continue to find ore, right? Then down at Roswell and San Antonio, which is 2.5 k to the south, joined by an underground drive. Roswell is absolutely open at depth, and our deepest drilling down there is only sort of 400 odd meters below the surface, but absolutely we could extend that by several hundred meters. We want to. I'm not saying that we will or we have. And San Antonio is open but more in chute, so we probably won't really get into that till we've developed the Roswell mine for a few years. And then we have other exploration tenement stuff around as well, and continue to get ore grade intercepts in different places. So I think the best way to explain it is, yes, they're open, but everybody will say that to you.
Yeah.
In 2013, when we bought this mine and started mining it, we launched with about 370,000 ounces in the mine plan, open cut and underground. We've mined already about 650,000 ounces, and we have the better part of the same again in reserve, right? So on a 380 odd thousand ounce plan, we're going to mine at least 1.3 million ounces, and that's all come from new resources, resource extensions, and of course a rising price has helped because it's lets us pick up stuff that originally we thought wouldn't fall into the mine plan, right?
Right.
But yeah, these resources are open at depth. We're already running for 10 years. Already been running for 10 years.
Yeah. That is the way the Aussie companies tend to play it. I think of a few in Africa have done the same thing. Started with a similar resource.
You're not going to drill 1 kilometre holes from surface, right? At $200,000 a hole, are you?
Yeah.
That's nuts.
Well, and just on that kind of drilling strategy, I mean, you've employed sort of a lot of air core drilling. You're looking for some new reason. I mean, what's the purpose of that? Is that obviously to kind of well maybe build up the reserve base, or what?
Yeah, no, true. So we traditionally do. We've done air core drilling in a couple of places. We've done it over at Boda, which we haven't turned to, and we've done it to the south of Tomingley. So, like all of these things, you start with lowest cost to highest cost, which is sort of most theoretical to least theoretical. So you do your gravity, your electromagnetics, IP, and then you take soil samples, rock chips, do ground mapping, and then you go and do air core. And of course, the air core is simply going deeper. You're often taking into fresh rock, just grabbing the first bit of that rock, right, and looking at that, and it creates a. Ideally, you'll be getting all grade, bits of gold, but it'll create a geochemical, picture for you that helps you then when you go to RC drilling, which is the next level of expenditure. Again, you're much more targeted and zoomed in. So absolutely, we continue to work our tenements, looking for additional gold that could feed economically into the Tomingley mill, as well as pure grassroots exploration, of course.
Right, and just in terms of that, obviously people are very much focused on you moving those ounces from low 70s to 80,000 plus, which is great, and all that development work seems to be advancing nicely. But that exploration component is so important. So how do you allocate capital? How do you prioritize targets when you've got all of that other stuff going on?
From 2018, when we discovered the extensions south of Tomingley and we're looking to extend the mine life, we went through a period of time of spending nearly $15 to $20 million a year drilling out those resources and reserves, right? So we were allocating most of our drilling capital was getting a new mine ready, because we had to take that through approvals and stuff like that. In 2019, on a separate tenement package we called Boda, we discovered a very large porphyry deposit. We've since worked that up to 15 million equivalent ounces, roughly half value gold, half value copper, at 0.58 grams per tonne equivalent, where 2/3 of that resource is indicated, right? So not just inferred, but indicated. So it's a substantial ore body. And so that's taken a large part of we've spent the better part of $40 to $50 million there over that period of time, right? Because we have the broad view that if you explore to find something that you can mine. Now, of course, investors will get a return from something becoming nothing into a potential ore body, or even an ore body itself. But that's where the value caps out. It may rise and fall with commodity prices. That's the value caps out until somebody mines it, right? And so we're very much of the view that the most value you can get beyond that initial discovery is getting it ready to mine, and if no one else wants to mine it, we go mine it, right? And so we've done that at Boda. That's why we drilled it out to indicator, because that's given us sufficient information to do the environmental surveys to take it through to approval. And you need something approved, and approval's always a prick, and approval takes time. So you've got to get onto that early, otherwise you're just burning time. As well as that, we have obviously a very experienced and sensible team, and so we allocate a portion of risk capital to finding whole new ore bodies. But we would broadly allocate, if we had at the moment, we're going to spend roughly $5 million doing extensional stuff up above Boda Kaiser, extensional stuff below Tomingley, and that's separate to the couple of $1 million that we spend doing extensional stuff underground, which we don't call exploration, we really call it operations, even though it's not.
And what do you do? I mean, it's going back to a slightly earlier point. And I think I'm glad you went there, because I was going to ask about kind of moving it further through to indicated, etc. But in terms of when you started, you want to get going, get some revenue flowing. Now is the job more about extending the life of mine, because that's kind of what the institutional guys want to see. They want to sort of see the scale of the opportunity. The pace at which you produce those ounces, I guess, can be addressed through development programs, but the life of mine is also an important factor in how they kind of value you, I guess.
Yeah, totally. I mean, so you always, I'm always asking myself, and you'd be asking yourself, all investors asking yourself, how am I going to make money out of insert stock, in this case, Alkane, right? And there's only two ways you're going to make money. If we turn the current share price, it's closed at, I don't know, 62, 63 cents today, into something higher, or, and then of course it needs to have prospects or something, no one else is going to buy it, or you declare a dividend. They're the only two ways something's going to happen, right? So if you have a short mine life, then you will start to lose that value, because of course stuff doesn't rise. I mean, logically, your company would be valued at NPV, and then it would slowly dwindle as the mine went down, and then when you discovered some more, it would go up to NPV. Of course, stuff doesn't work like that. You have commodity prices and mishaps and discoveries and all that sort of stuff, right? So in our particular case, right now, as we're going through this inflection point, we've spent money over a 2.5 year point, and we're going up through into generating cash. We're looking at, how do we make people money? Well, there's dividends, which we'll review when we get to the end of the financial year. And then there's growing the company's share price. Yes, it should grow when it goes to being cash generating rather than cash consuming. The company's share price should grow irrespective of dividends, because that's what's happened to nearly every other ASX producer who's done the same thing. And there's a very large valuation gap between our ounce profile and other people's profiles. So you would expect some of that to be regained that would bring people a capital gain. The second point of that is we continue to explore, because if you look at some of our exploration stuff we've done, we've added tens or hundreds of millions of dollars of value to the share price at different points in the company's history from those discoveries. And then we also look at mergers and acquisitions, because, and you and I have discussed this topic before, single asset companies come with the chance for great return because they're undiluted returns, and great risk as well. And we believe that the cash flow point that we're entering into, really paired with another developer or another cash flow producer, really has the opportunity to unlock a lot of value at this point in the cycle, provided you're not doing something crazy. But if you take a developer, because money's still not flowing into developers much, right, for finalisation. So if you take a developer, pair it with a producer, and then in a year and a half, 2 years' time, you're a double the producer with 7-8 years mine life out of you. That's a very attractive prospect, right, both from a capital gains perspective and the capacity to pay dividends. So we look at, can we do that inorganically by M&A stuff, or can we do it organically through exploration? And we're a little bit unique in the amount of exploration we do, but
well, it's those are cheaper answers. That's for sure. But what do you think that?
Yeah.
But what do you think the market? By that I mean the institutional boys and girls. What do you think they're looking for? Because traditionally it's like just buy me the answers, and we'll talk about how efficient that is later. M&A seem to be rewarded, right? Even high, when you're overpaying, or highly efficient acquisitions seem to be rewarded in the market. Do you think there's a kind of, do you think that mentality still exists, or do you think your kind of organic route will be rewarded?
It's a very, very interesting question, and at some point through this part of this conversation, different investors will yell at the screen, saying how wrong each of us may be. But so it's really interesting. I think a broad, and I'm really only talking about the ASX, so people on AIM or TSX will have to forgive me on this, but you don't really see a lot of institutional, and I'm talking fundamental institutions, buying in and out all the time. Right, they're news, capital allocation players. So day-to-day fluctuations are broadly driven by index funds buying in and out, and or retail investors buying in and out. You have a different thing that people are looking for. So retail investors, depends on their time frame of investment as to what they're looking for. They may just simply look for news flow and momentum and making a quick return, or they might be saying, okay, these people are going to give me money back. I'm after dividends. I want that. Or you're after people that say, I want a capital gain, and I have a 3-year hold. And those things are quite different. I have all those different people, on our register, right? But institutions, in general, are looking to outperform the index, or they are index funds, right, themselves. And so people looking to outperform the index are generally looking for high conviction momentum stories in order to get into. Yeah, they're looking for undervalued things that are coming through to production. So you're not seeing institutional people move on to developers, for instance, and yes, unless those developers are assembling a funding package to move them to something a lot more critical. I don't know if I've answered the question correctly.
Well, like I say, I don't necessarily think there is a correct question, because each fund will have its own view on these things. And it's, the guys who like your attitude to, moderation and conservative allocation of capital, because it gives you the biggest returns, they'll be drawn to that. And others will want, I need instant gratification, give it to me now, go and spend all of your money on M&A, and I don't care the price you pay. I care very little about the price you pay. Just kind of maybe finish off with like 2025 to basically answer, when we even answer that question better, it would be say, like, here's what I'm going to do for 2025. So can you just lay out those sort of timelines this year and say, right, these things are valuable and they will guarantee this movement of, production of ounces in a high price gold environment, and we can all take advantage of that. So what are you going to be delivering this year?
We're going to bed in these expansions I spoke about that we've just commissioned. So we're going to bed those in so that we get the return on capital that we put in. We're going to move to being returning cash flow, right? So growing our cash balance, and that will be different from what people have seen. Obviously, we continue to retire our hedges, right? So we don't roll them, we don't kick the can down the road, we just get it done, right? And we've already retired maybe 30% of the hedges since we took out the debt, right? So we will continue to get that done. So people will see, slowly increased leveraging to the forward price if people have a view of the forward price remaining this high. We will start work on the next phase of open cut expansion, which is moving a national highway. So we'll, announce what we're doing with that, updating the timeline, so on and so forth. And I would like to think that we will be doing something in some sort of, corporate transaction that creates value for shareholders by either enhancing some of our capabilities, which are, we can develop, we can produce, we can run, we can get stuff approved, or removing some of our perceived weaknesses, which, has been, our balance sheet, or might be the hedging allocation percentage of people, or things like that, or the medium-term growth, because we've got long-term growth with the porphyry and short-term growth with the production profile. So, they're the kind of things that we look at as being interested in. So I'd like to think that we would, as in this space, no guarantees of that, but I would very much like to think that, come Christmas time, we would be talking about how interesting that was and how that has, added value.
Well, it's just, I guess, taking care of the balance sheet is what you're doing with all of that activity. And I guess that's the exciting thing. Do you think that in terms of your profile then, end of this year, will be comparable to some of the Aussie gold producers? So really kind of, that make gains, right? That people are expecting great things from them, whether or not that's fundamental value or not. The profile is important. So, is it going to be important to you at the end of this year to kind of get people to compute properly?
I think so. Because several of our peers have had significant increases in value by moving to a cash flow positive position versus a cash flow neutral position, even if they've then fallen from cash flow positive back to cash flow neutral. Right, so
interesting.
So I do expect, and anticipate some sort of recognition for that. I think one thing that we will, and hence why I talk about inorganic growth, is we do need to show a pathway to medium term growth, right? And by that I mean in the three-year time frame, because if you look at other people who have, more buoyant valuations than us, many of them are showing how they can go to double what our production is. So, we have a pathway through to 100,000 ounces, but we don't have a pathway to 200,000 ounces, right? Other people are painting that pathway, and we'll let individual investors be the judge of them and how they get there and all that other sort of good stuff. And, that's important for two reasons. One, of course, more ounces, lower cost, more money, of course, in this thing. And a lot of those companies will and others will come under, well, what are you going to do with all this cash? You've got $500 million. What are you going to do? You're going to return it to people, etc. I look forward to the day that's us. But another thing that's just a truth, and you and I have chewed the fat on this before, is index funds exist, right? When you move into the ASX 300, then your liquidity automatically increases. And then you open a new world of fundamental funds as well as index funds are interested, and so on and so forth. And so you used to be able to do that being a 100,000 ounce producer, but now you have to be a 150,000 ounce producer to do that, right? That's not a hard truth, but so absolutely, I do expect some degree of junior consolidation within the ASX market, simply in order, all aside from all the balance sheet things and all the other very, very logical reasons to do it, but just simply to increase liquidity through access to going to the index funds. I do expect, not necessarily us, could be us, might not be us, but in this coming year, I think we'll see that.
Nick, appreciate your time today. Good catch up. Obviously, exciting year for you in terms of deliverables. Now you just got to go and do it. Easy, really, isn't it?
Well, yeah, we're already doing it. So I'm pretty chilled about that, to be honest.